Awesome. So let's hit the ground running. Today, we're talking about tax efficient withdrawal strategies. And this is a topic that really hits home for us because, again, we're big proponents of tax planning and tax efficient withdrawal strategies. Where you're going to pull from in any given year is basically the game when we're talking about tax planning. Okay. This is going to be really wrapped in, again, with taxes. Everything should be thought of as tax first in retirement as we're making decisions. And so again, this should be a pretty good presentation. Let me know if you have any questions. As I was building this presentation, it took me a little bit longer than usual because there's so many different aspects, different ways that we can go with this presentation. Okay. What I decided to do is basically build out a framework for how to choose which accounts to take from in a given year, because everyone's situation is going to be different. Okay. And so this is going to be more of a framework type presentation. If you guys would be interested in this, and let me know in the comments below. My thought is to get more in depth in future videos and future Wealth Wednesdays to maybe record case studies, okay, and walk through more specifics on the tax efficient withdrawal strategies for specific cases. And hopefully that'll give you an idea. Let's say we get 5 case studies in. There's probably someone that we do a case study on that pretty much matches your situation. So you can kind of get a more in-depth look at your situation. So let's get into it though. In preparation for designing this presentation specifically, I went ahead and Googled just tax efficient retirement withdrawal strategies. And there's a lot of information out there. Unfortunately, there's a lot of misinformation out there. So again, this is going to be such a critical tool that you use within your retirement. And the thing that I kept noticing time and time again were people explaining set models that everyone should use. And a critical takeaway that I want to make sure everyone understands right off the bat is that there are no set models, no one size fits all strategies. Okay, this is going to differ person to person because everyone has a different situation moving into retirement. We'll talk about some differing situations and how that might change your retirement account withdrawal strategy. But just know, again, there are no set models. What works for one person is going to look different for another person. Now, there are themes where people with, let's say large tax deferred accounts, they might have similar strategies. But again, every person's ideal withdrawal strategy, their optimal withdrawal strategy will differ slightly. Okay. So let's talk about the withdrawal landscape and just kind of lay the foundation. So while you're working, while you're in the accumulation phase, taxes are fairly simple. Okay. Most everybody is earning money from their job. Okay. And that's completely taxable. It plugs right into the federal income tax table, state income tax table. And basically what you earn, again, it's pretty straightforward. It's taxed on basic income tax tables. If you're a business owner, there might be some differing compensation that's applied differently, but nonetheless, things are pretty straightforward. Now, when you enter retirement, why withdrawal strategies are so important is because now you enter a phase where there are multiple different buckets that you can choose from, each having a different tax implication. So kind of just to briefly go over these tax buckets. First, you have a taxable account, a brokerage account, a joint account, a non-qualified account, whatever you want to call it. And this is a bucket that a lot of people view as a leaky bucket because anytime that you have fixed income within this bucket, anytime that you make a change within this bucket, it creates a taxable event that you now owe some kind of taxes on. So a lot of people view this as a leaky bucket. You can patch this bucket though with better planning. Okay, we've recorded multiple videos on that. I'd be happy to link to any videos that we reference throughout this presentation. If you just let me know in the comments below that you want to learn more about a specific topic, I'd be happy to link or tag you in those videos. In the middle bucket, we have the tax deferred account. So this is an account where basically the income you pull from this account is going to be treated a lot like the income you earn when you were an employee. It's fully taxable. It plugs into the normal income tax tables. Okay, this tends to be people's largest bucket because you got a tax break while contributing to this. Sometimes you got a 401k match while contributing to this. So this tends to be the largest bucket for retirees. Okay. Finally, you have the tax-free account. Most common type of account within this bucket is going to be a Roth IRA that we're going to be referencing in this presentation. Obviously, HSAs fit into that as well. So 3 types of money, right? Is that all there is? Well, no. Okay. If we are only looking at these 3 different accounts, we're forgetting a very critical bucket that needs to be thought about within our withdrawal strategy. And that bucket would be Social Security. Most everyone has a Social Security benefit. And again, Each of these buckets has a different tax implication. Well, Social Security has its own separate tax implication as well. So this is a tax bucket that, again, this is the fourth tax bucket that we need to be planning for and thinking about. And as you'll see later in this presentation, it's one of your most impactful buckets in terms of making sure you have a tax efficient retirement income stream. So the most common strategy, as I was Googling around and just looking at what other people are recommending for retirement withdrawal strategies, and also what we've seen from analyzing retirement accounts, the most common strategy, unfortunately, is a terrible strategy. Okay, here's basically the kind of how most people look at the most common strategy. Okay, Social Security first. Basically, as soon as you retire, whether that's 62, 65, or 70, basically file it for Social Security as soon as you retire. Not a whole lot of thought put into that. But again, this tends to be the most common strategy because, again, you don't want to be pulling extra money from your retirement account. So they'll tell you to just file for Social Security as soon as you retire. From there, any additional income you need on top of that, take from your taxable account. Again, this is the leakiest bucket. So take from that account first. You want to basically extinguish that account. Okay. Again, this is the wrong information. This is the wrong advice because, again, if you patch the holes of that taxable account, it can actually be a very powerful account. It can actually be a very tax preference account. You'll see this as we go through this presentation. Then they tell you to take tax deferred account second and leave tax-free account last. Okay. And again, this is a very rule of thumb, very boilerplate strategy. And again, it's a very poor strategy. You'll see this as we go through time. You're basically leaving a ton of money on the table in terms of Social Security. You're delaying taking from a tax deferred account. So RMDs are going to be an issue down the road. You're extinguishing that taxable account that could be a tax preference account if you manage that properly. And so again, this is a terrible destructive strategy. Please do not follow this. Okay. Despite it being probably the most recommended strategy. Okay. What I want to do is I want to take you through, again, this framework, these steps that we take when we're looking at a client situation, trying to identify the most optimal withdrawal strategy. Okay. The first step is identify the weaknesses, identify the hurdles. So invariably everyone within their plan, and it's relative to their plan, will have some kind of tax weakness. Okay. Again, probably the most common tax weakness that we see are large tax deferred accounts. And why is that a weakness? Well, because later in retirement, you're going to be forced to take money from that account, whether you want to or not. And again, with growth, those RMDs can grow fairly large. And so to step back, to be able to identify the weaknesses and hurdles, you need what's called a forward-looking tax plan. Basically, what that means is you want to have a tax plan that lays out what your situation looks like, not only in year 1 of retirement, but in year 25 of retirement, in year 30 of retirement. So you know at the beginning of your retirement, what tax hurdles are going to come down the pipe. And again, once you're in those hurdle zones, it's very difficult to deal with that. So again, in the early part of retirement, you need to be planning for things that are going to happen 10, 20, 30 years down the road. Okay, so in this situation, what we're looking at here is a forward-looking tax graph. And basically what this is it shows this person's income being filled from various sources. And what we'll see, and this is very common, especially with people that have tax deferred account issues, early in retirement, they're in some optimal tax planning zones here, where their taxes are pretty low overall. But once RMDs start at 72, because they weren't dealing with these tax deferred issues earlier in retirement, we see RMDs are pushing them into the next tax bracket, which would be at that point after the Tax Cuts and Jobs Act, the 25% bracket, then pushing them even into the 28% bracket. And then later on, we see them pushed into the 33% bracket, even with RMDs. And again, what you'll notice with this jump in the tax brackets down here is the Tax Cuts and Jobs Act. This next jump is basically when one of the spouses passes away. So this is something called the widow penalty. I'm not going to talk too much about all of the intricacies of the widow penalty. We have other presentations on that. But again, what you'll notice are these tax implications really start to weigh down this person's plan. So in this person's plan, RMDs are the weakness. That's not necessarily going to be the case in everyone's plan. Okay, what might be another weakness, or not necessarily a weakness, but a hurdle that you need to plan for? Well, if you're retiring prior to 65, and we'll go more in depth into tax efficient withdrawals during this phase, but if you're retiring before 65, you need to find some kind of healthcare option that's not Medicare. Medicare is going to begin at 65. Well, typically it makes the most sense for people to enter into the public ACA marketplace. Now, your costs are tied directly to your reported income. You can earn a subsidy. The lower your reported income, that subsidy helps you in two ways. It's going to lower your monthly premiums, and it's also going to lower your deductible. Okay, so this is a situation where if somebody's retiring, let's say at 62, and they're going to be on ACA for 3 years until they're 65. Okay, there's different planning that needs to happen here. If they just take all from one account, specifically a tax deferred account, without thinking too much about ACA planning, they're going to lose a subsidy. And losing a subsidy is a very big deal. Okay, you can go from basically, if you're earning a subsidy, if you're planning properly, you can go from paying basically nothing for a monthly premium, having just about nothing for a deductible on an ongoing basis, versus not having a subsidy, paying more than $1,000 for a married couple for health insurance, and having a deductible that's above $5,000. So this is a huge planning element where, again, there are going to be different phases of your retirement. And those withdrawal strategies are going to change in those phases. So that's why a boilerplate withdrawal strategy doesn't work. Now, we'll talk more about ACA planning here as we move through. But here's another one most people don't think about: a pension or forced income. Now, it seems that a pension or forced income is a very good thing. Okay, it's money that if you were working for the government, if you were working for a company that has a pension, that seems to be an extra benefit. And it is, okay? Having guaranteed income is a good thing for the most part. But the problem is forced income can also be a weakness and a hurdle. Reason being is because most pensions are fully taxable. So this is forced income that you are forced to take whether you want to or not. Anytime there is forced income, whether that be from a pension, an RMD, that basically destroys withdrawal strategies. Because again, we want to have the ability, the optionality to take from certain accounts at a different time based on our tax tables. Well, we don't have that ability depending on how large that pension is. So again, pension, forced income can come in the way of an income annuity. That's generally why we aren't a big fan of income annuities, because again, it's forced income that typically, again, is fully taxable, that you don't have the choice to take or not. So in this person's situation, and again, if you're not sure what this graph is, we'll explain this a little bit later. It's something called the Social Security tax torpedo. But forced income at a fairly high level can change your planning. Because again, generally we're fine with a certain level of RMDs. Okay, especially within the standard deduction or lower tax brackets, we're fine realizing tax deferred account assets or tax deferred account withdrawals in those lower brackets. But all of a sudden, if you have RMDs on top of forced income, on top of a pension, that turns into a situation where those RMDs, in addition to this forced income, can push you further within some of these tax traps. So that's a situation where somebody with large pensions might want to eliminate almost all of their tax deferred accounts. But again, we can kind of see that this varies from person to person. Okay, so what are some weaknesses and hurdles that you need to be thinking about? Again, I will say the vast majority of people, the vast majority of plans that we build, it's usually tax deferred accounts. Okay, again, this makes sense. Most people save the majority of their income in tax deferred accounts because of the deduction. They also get a match from their work. Again, it just generally makes sense. But this becomes a problem within retirement, primarily because of RMDs. And also because just that full amount of withdrawal is now fully taxable. Okay, so what can RMDs do? Well, as we saw, they can push you into additional tax brackets. Okay, that's generally not a good thing. They can push you into the widow trap, causing the surviving spouse to pay significantly more in taxes. Potentially Medicare raises. They can push you into the Social Security tax torpedo. If they're passed to the next generation because of new Secure Act laws, they can be a pretty big tax burden on the next generation. Another issue we see, if it's not a large tax deferred account, sometimes it's a large taxable account. So certain people save more in this account because maybe they want access. Maybe they don't want to wait till 59 and a half to be able to access that money, specifically if they're retiring prior to 59 and a half. So this is something we often see. We'll talk about some different issues that come with that. ACA planning is usually a phase of retirement, but nonetheless a hurdle that we need to plan for. Forced income and pension planning, we just talked about that briefly. If there are options that we can take lump sums to avoid some of those tax issues, that's something we should definitely think about. Inheritances you receive. Now, this is a tough one because no inheritances are guaranteed. Specifically, as people age, just bad decisions can be made that can destroy inheritances. So it's not something that we want to for sure 100% plan on, but it is something we want to stress test a portfolio on. If you receive a $500,000 IRA at the wrong point in your retirement and you're forced to withdraw from that IRA and a similar RMD way that the Secure Act created these RMDs, fairly large RMDs that you have to take. Again, this is something that we need to be planning for. It can be a hurdle that we might want to eliminate all of our tax issues prior to potentially receiving that inheritance. The problem with inheritances there are a lot of variables there. So that's why we want to stress test it and show what happens if we receive inheritances at the wrong time and what can we do to avoid that. Moving to a less tax preference state. Again, typically you want to move to a more tax preference state, but if you're wanting to move closer to family, sometimes you just have to bite the bullet. Well, tax planning prior to moving to that last tax preference state or country can be a big deal. IRMA, Medicare hikes or increases, potential tax hikes. Again, when we host presentations, I go, who thinks taxes are going to go up in the future? Almost everybody in the room every time raises their hand. So again, to avoid that can be a weakness in your retirement. Capital gain bump zone, stealth taxes. Again, I'm not going to go through all of these. We have a ton of presentations on each of these. Okay, step number 2 would be identify your income target variables. And what do I mean by that? Well, based on what your goal income is at the beginning of retirement, a lot changes. So let's say you're in a married couple, okay, and you're looking to take $60,000 versus another retiree is looking to take $110,000 in retirement. Well, those are two completely different retirement withdrawal variables that will be added to that person's situation. Okay, I don't know if I have it next. Okay, I do. So somebody taking $60,000 versus $110,000. Well, all of a sudden, if that $110,000 person takes all of that from tax deferred accounts, they're going to be in the 22% bracket. Okay, that $60,000 person could take it all from tax deferred accounts and just be basically touching the 12% bracket. Okay, so again, there's different variables that will translate. Okay, so for instance, somebody taking $110,000, all of a sudden, when we look at the tax base of long-term capital gains are subject from your taxable account. Notice that if they're taking the last dollars that they need from their taxable account, they're going to be in the 15% bracket after the standard deduction. Okay, so there's different variables that will apply to you based on your income need. Just know that as well. Again, this will start to make more sense as we move through some specifics, but we're really laying the framework right now. And as part of that, you need to know how your income stacks in relation to how the IRS views it. Okay, and just know the order of stacking is optimal for your situation, meaning that it's not as if the IRS stacks it in a non-optimal way. It generally is optimal, but you want to know how your income stacks in the eyes of the IRS to know which accounts you should withdraw from in a given year. So first, the base that it stacks in is basically forced income or Social Security. The reason that's the foundation is because that's money that you really don't have an option to take. I mean, theoretically you do, but again, who would turn down a Social Security benefit just because they don't want forced income? Who would turn down a pension just because they don't want forced income? That's kind of stepping over thousands of dollars in order to pick up dimes. Okay, so that doesn't make as much sense. Again, forced income, Social Security is going to be the base. From there, the next thing that stacks is traditional IRA withdrawals. Okay, so again, that's fully taxable income. After that, capital gain stacks. Now, this is important to know because if it's stacked in the opposite order, that capital gain stacked first, that wouldn't be very optimal. Because again, if you pulled $10,000 from long-term capital gains and then the rest from income rates, sure, all the money you pulled from long-term capital gains would be at 0% because that's the first money that stacks. But then the less preferenced income tax rates would be last. So you could be pulling into the 22% bracket versus if it was switched, you're pulling income in the 10 and 12% bracket and then realizing the last income in the 15% bracket. So again, this is generally the optimal way, but it's important to know how your income stacks. Lastly would be Roth withdrawals. So the reason this is important because I'm going to go through a situation over here where somebody's pulling from multiple different accounts. And so this is after the standard deduction. We're looking at taxable income. They're pulling $80,800 from their IRAs. So notice at the tax base of $80,800, any long-term capital gains now moves into this 15% bracket. Before it would have been in the 0% bracket. So again, as this person is pulling from their account, they need to be thinking about these varying tax withdrawal rates, varying account tax rates. So if they're pulling $80,800 from their IRAs, obviously they're pulling a little bit more of that because of the standard deduction. But let's say on top of that, they're pulling $10,000 from their long-term capital gains. Well, the way this person's situation stacks, Their IRAs are going to be subject to the 10% and then the 12% bracket, and obviously under the standard deduction, 0%. But then this final money could have been in the 0% bracket had they changed their withdrawal strategy, but it's actually in the 15% bracket. Okay, so what could this person do differently, again, if it made sense? Well, notice the last $10,000 here that they're pulling from their IRA, okay, is stacking and pushing their long-term capital gains from 0% up to 15%. So what they could do instead, again, if it made sense, depending on all of the other things going on in their situation, they should pull less from their IRAs. They would realize this long-term capital gains in the 0% bracket, and they're still filling the same amount of income, but they're filling the last 10,000 from Roth. Why would they do that? Well, again, Roth exits the tax system, at least from a withdrawal standpoint. And so rather than their long-term capital gains being pushed up to be taxed at 15%, they're keeping these long-term capital gains within the 0% bracket. The Roth is in the 0% bracket. So the last $20,000 worth of income, they're avoiding this extra 15% tax, basically. So this is, again, in relation to the capital gain bump zone, we just had a Wealth Wednesday on that, talking about how you can avoid that. But again, this kind of shows how income is stacked. So let's start to get into the specifics. Okay, how can you create a tax efficient retirement income stream? The first kind of, again, foundational element is using the Social Security bucket wisely. Okay, so based on when we file, assuming full retirement age is 66, this will adjust if full retirement age is later. But basically you receive about a 7% penalty for every year that you take Social Security early. You receive an 8% step up in benefits for every year that you delay. And it's broken up monthly. So again, if you delay 1 month later than your full retirement age, you'll get a percentage step up. You don't have to delay for the full year. But it's important to know that based on when you file, you're going to have vastly different income amounts coming from Social Security. This is pretty basic information. We've covered this again in other Wealth Wednesdays. But basically, if your full retirement age is 66, there's a 76% difference in monthly benefits. Now, something that'll become very apparent here in a sec is Social Security is a very tax preference asset. The more that we have coming from Social Security relative to other buckets that we can pull from, the less we will pay in taxes. Social Security is one of your most beneficial assets because of taxes. A lot of people lose that as they're thinking about when to file for Social Security. Let's go through a situation. Okay. Let's say somebody needs $90,000 of income, $75,000 per month net of taxes. Okay. Let's say they had no Social Security benefit. They were pulling it all from traditional IRAs. Okay. In 2021, a married couple looking at federal income taxes would owe about $7,400 in taxes, pulling $90,000 from their traditional IRA accounts. Okay, let's say they both have a Social Security benefit, but they file for that benefit at 62. Okay, again, by filing at 62, they get penalized for doing so. Okay, so their benefit now is $43,000 coming from Social Security. They're going to have about $47,000 that they're pulling from their IRAs in order to equal that $90,000 of income. And notice what happens to their taxes. It does go down. The reason being is because Social Security's tax preference, and there's a savings that is translated to filing for Social Security. Okay, so notice taxes go down about almost $2,000. What happens if they take a more suggested strategy? I don't remember in this situation if I used split strategy, somebody taking at full retirement age, the other delaying to 70, or if I had them both delaying to 70. But basically, I think it was both delaying to 70. But basically, from $43,000, they would now have $75,000 coming from Social Security. So the majority of their income is funded through Social Security. They're having to pull an extra $15,000 from their traditional IRA assets. But look what happens here to taxes. Okay, $312 in federal income taxes that they owe. And this is actually not exactly true because I'm using the normal standard deduction. So actually, if you use the over 65 standard deduction, this would actually probably be eliminated altogether. But that being said, notice what happens based on different filing strategy. Notice what happens to the taxes. It goes from paying quite a bit in taxes to paying $2,000 less to paying almost nothing in taxes. So delaying Social Security because of how tax preference it is can be a very wise strategy, at least for one person in this situation. But again, that's not all Social Security allows for. Again, once you're on Social Security, there's obviously tax savings the more you have coming from Social Security. But the other thing is when we think about coordinating our other assets with our Social Security strategy, Social Security creates what I call a cleanup zone. Okay, basically what I mean by a cleanup zone is by delaying Social Security, you basically open yourself up to a period of time where you can clean up a lot of your other tax issues. So when on that first step, when we identify the tax issues that we're going to have in retirement, this cleanup zone basically saves you from dealing with those tax issues throughout your entire retirement. Once you're on Social Security, things get more complicated because as you're pulling from other accounts, you're causing Social Security to be taxed additionally. So essentially you're double taxed. That's something called the Social Security tax torpedo. Delaying Social Security allows you to realize and deal with other tax issues. Now, this is going to vary for everybody. I will say the optimal zone, or the zone that a lot of people can clean up a lot of issues, is going to be the same for, is going to be consistent, I should say, from 65 to age 70. Reason being, you're on Medicare, you have a lot more room to realize income, report income without penalties. And then again, at age 70, both of you would obviously be on Social Security if you delay it all the way. So 65 to 70 is a great cleanup zone. Before 65, it's going to vary for everybody. Okay, if you have some kind of COBRA insurance from work that you're on where reported income doesn't matter, this can be a great cleanup zone as well. Okay, if you're on ACA insurance, this is less of a cleanup zone and more of a planning zone. Okay, so this is going to vary for everybody. Once you're on Social Security, again, things get more complex because of that Social Security tax torpedo. Okay, so what can you do? Let's say you have tax deferred issues during this zone. And again, we're delaying Social Security, so we're providing ourselves with this cleanup zone. How can we deal with tax deferred issues during this cleanup zone? And why would taking Social Security early ruin this cleanup zone? Well, think about it. Okay, if you're taking Social Security early, okay, not only are you taking a penalty from having a lower benefit, but now you're filling up lower brackets with Social Security income. Again, in a cleanup zone, we don't want that. We want to be able to have full tax tables, full tax room in order to deal with issues that we're going to suffer from down the road. So again, let's say RMDs are going to be issues because of large tax deferred accounts. What can we do to deal with these issues? Well, first off, delaying Social Security allows us to take withdrawals primarily from our tax deferred accounts. So you go from a situation, if you need $70,000 worth of income, you can now pull $70,000 from your accounts, from your tax deferred accounts. That's going to help minimize RMDs. Okay. Why would we want to do that right now? Well, the Tax Cuts and Jobs Act is an optimal zone where we actually want to be paying more in taxes to avoid paying more in taxes down the road. We're going to have to pay them sometime. We want to pay them in an optimal tax environment. On top of that, we can do conversions. So not only, let's say we're withdrawing $70,000 from our tax deferred accounts, but it might make sense to do conversions on top of that. What do I mean by conversions? Taking money from a tax deferred account, paying taxes on that money today, converting it to a Roth. Finally, and again, this is kind of you should be doing this throughout your entire investing career, but tax location investing. We just recorded a video on this on our YouTube channel, basically putting the right assets in the right account. Still keeping the same asset allocation, but just asset locating properly. What does this mean? It means staying more aggressive with your Roth accounts because that's money that's will be tax-free. So we want that account growing as large as possible. If we're going to have safety within our accounts, we want those in the tax deferred accounts. Because again, safety means we're accepting a lower growth rate. Accepting a lower growth rate means we're minimizing RMDs. The other thing is while that safety lines up perfectly with our tax deferred accounts, our tax deferred withdrawal strategies. Because again, we have the safety as we're pulling from that account. So luckily those things align. And what does this look like? I should say, if we step back for a second, this is a concept we talked a lot about. Tax Cuts and Jobs Act. It's put into law in 2018, set to expire in 2026. It creates a zone where this is a once in a lifetime opportunity for you to realize taxes at lower rates than you will see later in retirement. So people say converting right now seems crazy. I don't want to pay more in taxes. Well, I say not converting right now is crazy because you want to pay more in taxes because again, in 2026, the 12% bracket is going to become the 15%. The 22 is going to become the 25. The 24 is going to become the 28. So the Tax Cuts and Jobs Act raised the standard deduction for a married couple by about $10,000 and lowered each tax bracket by about 2 to 4%. This is a big deal. Okay, 2 to 4% doesn't seem like much, but in conjunction with a lower standard deduction or a higher standard deduction, I should say, it's a very big deal. You want to be realizing income right now. So what does that look like? And again, conversion strategies are going to look different for everybody based on what that RMD situation, that hurdle looks like. Okay. So for this specific person's situation, we had them maxing the 24% bracket for 2 years. And then for 3 years thereafter, basically filling in the 22% bracket and then the 25% bracket. And basically what's going to happen is they're going to go from being taxed at 25%, even into the 28% bracket. If we see better growth, they probably would even be pushed into the 33% bracket, to now basically eliminating a lot of these RMDs. These RMDs are still going to fill some lower brackets, the 15% bracket at that time. But we see overall, there is a huge tax savings. Now, this tax savings will vary widely. Some people will see a larger tax savings from a Roth conversion strategy. Other people will see a lower tax savings. It all depends on your situation. But again, this cleanup zone allows you to clean up these tax deferred issues. There are 3 reasons for Roth conversions. 2 of these are often overlooked. So the first one is obviously to avoid or minimize tax hurdles. That's pretty much a no-brainer, right? Avoid RMDs. That's what we talk a lot about in these presentations. But there's 2 other reasons as well. So decreasing future tax risk. If you're someone who thinks taxes are going to go up, again, the big question is by how much? But again, having money in tax protected accounts eliminates that tax risk. And again, when I poll the room in events, everybody raises their hand. So then the question is, how much should we be stress testing your portfolio, and how does that change our conversion strategies? Finally, make other assets more valuable. So the more that you have in Roth, the more valuable other assets can become. Think about your taxable account, that range where we can realize long-term capital gains at 0%. Well, if we don't have large RMDs, we don't have large tax deferred account withdrawals, all of a sudden now we have a lot of room that we can realize taxable account gains within that 0% bracket. So eliminating the tax deferred issues makes the taxable account more valuable. So 3 reasons for conversions. We'll probably host Wealth Wednesdays on some of these 2 reasons that are often lost. Let's say somebody has a different issue with large taxable accounts. Usually this is, again, a situation where somebody wants the control over their money prior to 59 and a half, or they're retiring prior to 59 and a half. And so they save a lot of their money in a taxable account. Let's take a hypothetical situation. This person has a $1.8 million taxable account. Let's say they have $300,000 outside of that in a tax deferred account. So the tax deferred account is a secondary issue. Their cost basis is $1 million, which means they have $800,000 in gains, which is quite a bit in terms of unrealized gains. And so the big issue in this person's situation, it's not so much the large taxable account, it's what's happened over time. So this person, let's say, has been saving in this taxable account throughout their working career, and they've been allocating to some specific stocks. Let's say stock number 1 is Apple or Amazon, something that's had a ton of growth over the years. And so as this person has been saving within this account, this stock position, this first stock position, has gotten very large. You'll notice off these 4 stock positions that I hypothetically kind of laid out for you, the majority of their money is within 4 stocks. And so there's a lot of concentration risk. Their retirement will go as these 4 stocks go. Again, if they have $2.1 million and 850,000 is in one stock, that is a ton of money in one singular stock. So what can this person do within the cleanup zone? Well, again, they're not taking Social Security. So they basically have no taxable base if they're not, besides for what they pull from their accounts. So again, based on their cost basis, they have $1 million of cost basis, 1.8 million total. So they have 0.8 million in unrealized gains. So basically, if we look at that tax gain harvesting zone of 0% long-term capital gains, they can realize $145,000 in those cleanup years and reset their cost basis or take some of that for income. Again, they will have gains as part of this $145,000 withdrawal, but all of those gains will be within the 0% long-term capital gains zone. And so in this person's situation, during that cleanup zone, we want to reset a bunch of this cost basis here at 0%. We don't have as big of an issue with tax deferred accounts that we need to worry about. So we want to reset the cost basis and diversify past these 4 stocks so that their retirement isn't solely focused on how well these 4 stocks do. Okay. And again, they can realize, a married couple can realize 0 to 80,800 of a taxable base in the 0% bracket here. So that turns out in this specific situation, $145,000 worth of resetting cost basis in order to basically use this whole zone here. Okay. What happens after you're on Social Security? Okay. Well, then you enter the Social Security tax torpedo. And again, ideally what's going to happen in this cleanup zone is that our goal in this cleanup zone, future RMDs are within our income need or in an acceptable zone. And what acceptable is going to mean is going to vary widely. So for some people that have really large tax deferred balances, I'm talking about multiple millions. Let's say you have $4 million in tax deferred accounts. Well, in that cleanup zone, we're more in a tax mitigation than we are in a tax fix. Okay, because again, you have to go pretty aggressive to go above the 24% bracket. So within that 24% bracket, let's say 5 years worth of $200,000 conversions, $250,000 conversions, you're only minimizing a portion of those RMDs. So this is going to be relative to everybody. Some people are going to be in a tax elimination zone. Some people are going to be in a tax mitigation zone. Ideally, we have those future RMDs where the RMDs are low enough that we accept basically filling up lower brackets or the standard deduction with those RMDs. So sizable tax deferred wealth is now tax protected in Roth as well. So again, when you enter retirement, you might have almost all of your money in tax deferred accounts. By the end of this cleanup zone, we want to have basically a more diversified tax breakdown where we have more of that wealth, not in a tax deferred account that's going to be a tax liability, but in a tax protected account. Large taxable balances can be all right in some cases if the rest of your situation is set up properly. So in the previous situation, this is not all right because they have so much concentration risk here within these 4 stocks. Now, if this is a person that has large taxable balances, but it's pretty diversified amongst a bunch of ETFs, hundreds of companies, that might be fine. But again, it depends on if we have the other issues cleaned up. Again, our goal is to have Social Security timed optimally. And our general kind of overarching goal is we want withdrawal optionality. What do I mean by optionality? You have enough at each account where in a given year after we're on Social Security, we can choose to take from certain accounts. We aren't tied. We aren't forced to take from any specific account. We have the withdrawal options. Okay, that's kind of this goal of this cleanup zone. So let's kind of get even more detailed into what happens if we use that cleanup zone properly. Let's go through a specific withdrawal case that I know a lot of people are going to be wondering about: Affordable Care Act planning. So again, just as a reminder, you're going to pay for basically how much you pay in healthcare costs in your deductible will depend on your reported income. The lower your reported income, the more or the less you will pay, the larger subsidy you will earn. So the first step in Affordable Care Act planning is deciding how much we actually want in reportable income. If you're someone who has underlying health conditions, you might want to have a very low reportable income, earn the largest subsidy you can. The reason being is because you'll pay almost nothing for monthly healthcare premiums, and your deductible will be very low as well. So your out-of-pocket costs, when you do have those out-of-pocket costs, will be very little. Okay. If you're someone that's very healthy, okay, that hasn't been to the doctor in years, and you want to take a little bit more tax deferred minimization is more of top of mind. You may want to report a little bit higher of an income. Yes, you'll have a little bit more in healthcare premium costs. Your deductible will be a little bit higher, but again, you don't have as big of a need for healthcare. You don't have as big of a healthcare need, so you can report a higher income. Use more tax deferred money in order to minimize RMDs. So in Affordable Care Act, we don't want to have Social Security. The reason being is because all of your Social Security benefit will be counted dollar for dollar against you, even the non-taxable portion. Ideally, if we don't have Social Security, we don't have any tax base that we start with. So we want to take tax deferred account first. Okay, now this is going to, again, vary based on what your situation looks like. Do you have the majority of your money in tax deferred, or do you have the majority of your money in a taxable account? What is the hurdle here? For most people, you're going to want to fill in the first base in tax deferred. So let's say that you want to report an income of $30,000. Okay, this might be a situation where maybe you're filling the full $30,000 of reportable income with tax deferred withdrawals. It might be a situation where you're filling the first, let's say, $10,000 in tax deferred. What you would do next if your taxable account is an issue, you want to fill in the rest with a taxable account. Now, the nice thing about a taxable account is only a portion of that is going to count as reportable income. Okay, so basically, let's say that you have 75% cost basis in your taxable account, which means you have 25% unrealized gains. So if we fill in the first $10,000 in tax deferred, and we want to report an income of $30,000, basically what we can do is we can take $80,000 from our taxable account, because only $20,000 of that $80,000 is going to be counted as reportable income, because that's only the unrealized gain. So basically with a taxable account, we can fractionally report income based on how much we have for cost basis and unrealized gain. And then finally, you fill in the rest of the income that you would need with Roth. That would be your last withdrawal. Usually, again, you want to fill in the base with tax deferred to minimize RMDs. You want to fill in the rest with taxable account. And then if you still need additional income, fill in the rest with Roth. Roth is completely unreportable. Okay, so there might be different phases where based on these years, you're changing this withdrawal strategy. But again, you're trying to take as high of an income as you need, but report a low income to earn that subsidy. So this is a specific withdrawal case. Again, if people have this hurdle. In general, we get a lot of questions on this in given meetings. Ordering strategies. What is optimal? Again, rule of thumb. So this is going to depend on how big of tax deferred accounts you have. For the majority of people, you are better off earning an ACA subsidy than you are trying to perform conversions. So if you perform conversions, you're going to raise your reported income. You're going to lose a subsidy. So most people will benefit more during those early years, earning that subsidy that might be worth $1,000 a month than they are to convert. Okay, now where this would switch, if somebody has tax deferred accounts, again, in the multi-millions, then we might say, okay, you should be converting, taking the ACA penalty. But again, we need those extra years of conversion. Otherwise, RMDs are going to rain a lot more havoc on your situation than losing that subsidy. Minimizing RMDs generally makes more sense than trying to reset cost basis, trying to tax gain harvest. Again, just in general. Larger conversions. This is something we're talking a lot about with our clients right now. Larger conversions in order to minimize RMDs might be worth taking the IRMA penalty. For most people, if tax deferred accounts are going to be an issue, if RMDs are going to be an issue, I would rather you take 1 or 2 IRMA penalties. Again, add that in as a tax to assess that conversion, but larger conversions typically make more sense. Okay. Delaying Social Security, I have in here, is a better idea than most any other idea you have. Again, I'm not saying Social Security is a perfect system. I'm not saying if we had the option to opt out earlier and save for our own retirement, I'm not saying Social Security is the best asset, but we're forced to pay into Social Security. And when we arrive at Social Security in retirement, it is a very tax preference asset. It's an inflation adjusted asset. There are 100 reasons that you should delay Social Security, at least one of you, to an extent. And it's almost better than any other kind of idea that you might have in retirement. Keeping some IRA balance is better than eliminating IRAs completely, typically. Okay, because again, we want some RMDs, we want some IRA balance to fill lower brackets, to fill at the very least a standard deduction, and then potentially fill the 10% bracket, maybe even into the next bracket. So typically you don't want to, completely eliminate IRAs. And then finally, there's a lot of what ifs that we can run on the tax planning front. What happens if they eliminate Roth conversions, what happens if they eliminate Roth IRAs altogether and make them taxable? Well, we can what if ourselves to death with any kind of idea that might play out down the road. Sure, they could eliminate Roths down the road. Okay. But again, we need to be planning under the tax laws we have today first and foremost, and then we can stress test some of those other ideas. If they eliminate Roth conversions, if they eliminate Roth IRAs altogether, guess what? There's not a whole lot you can do. Basically, they're going to force you to pay whatever taxes. You're much better off protesting than you are trying to plan for what happens if they eliminate conversions or Roths. Okay, so what happens, kind of wrapping this up, what happens once you're past the cleanup zone? Well, now you enter the Social Security tax torpedo planning. So again, this is created. What we have here is the marginal brackets created by the Social Security tax torpedo in blue. and then what intuitively people think their tax brackets are. How you read this graph, you look at the income from taxable sources on the bottom here, and you find your marginal bracket. So let's say you have $50,000 of income from taxable sources. You're going to first pay 0% underneath the standard deduction. This specific person is going to pay 18.5% because of, again, as they're pulling more money from their taxable accounts, from accounts that are taxable, it's forcing more of their Social Security benefit to be taxed as well. So what you'll see is a 50 to 85% rise in taxes. Now, this Social Security tax torpedo graph will look different for everybody. That's important to know. So as this person is pulling $50,000, they're taxed at 0, 18.5, and then 27.75%. Finally, if they continued to take more income, they would move further within this marginal bracket. So again, this is why we want withdrawal optionality during this time period, because these are the tax brackets that we're going to be planning under. Once you're past the cleanup zone, you want to know what this tax bracket for you looks like each and every year in retirement, because this is going to basically be how we determine retirement account withdrawals. Let's go through kind of a situation, an idea. And again, this will vary depending on what this person's situation looks like, but ideally what we would want to do, assuming this is kind of more of an average situation, based on how much this person has coming from Social Security, we might want to pull from our IRAs, our traditional IRAs. We want to pull the first, and again, I'm just going to kind of use round numbers here because I don't have the exact numbers laid out here based on these different colored phases. Let's say we want to pull the first $20,000 from IRAs. Okay. The reason being is because we're going to be paying 0% underneath the standard deduction. So the first $10,000 is going to be completely tax-free. The next $10,000 is going to be taxed at first a little bit at 15%, but then mostly at 18.5%. For a lot of people, that's going to be fine to accept. When we're paying in the teens for marginal brackets, that's completely fine. Next, you'd want to withdraw from taxable account withdrawals. They won't be paying 27.75% because remember, these taxable account withdrawals would be in the 0% long-term capital gains bracket. So it would still push more of their Social Security benefit into being taxed, but essentially they would owe, in this person's situation, 15% times 0.85, they would be owing about 12%. That would be their marginal bracket here. The reason being how I arrive at that is you take 15%, you times it by 0.85%. The reason being is because all long-term capital gains that they take is going to, yes, force more of their income, Social Security income into being taxed, but they're not taxed on that taxable long-term capital gain withdrawal. So they're only going to owe a fraction of this 15% bracket. And then finally, as they reach the tail end of when they'll be pushed into the most volatile part of this Social Security bracket, or the Social Security tax torpedo tax at 46.25%, they'd want to fill in the rest on top of this in Roth withdrawals. Okay, now these zones will vary slightly. Okay, so maybe somebody who has lower IRA withdrawals might just want to take the first $10,000 from IRAs, take the next from taxable accounts, and take the last from withdrawals. So basically, we want to move this kind of sliding window over a little bit. But this is why you want optionality in retirement, because you want to be able to take from certain accounts at certain times. Okay, if you have forced income, this is going to look much different. Okay, you might want to, again, if forced income puts you right here, you might want to take only Roth after this. You might want to use this taxable account primarily as a way to pass on money to the next generation because you'll get that step up in cost basis. So again, there's still a lot of different things that change this period. But again, hopefully this gives you an idea of once you're out of this cleanup zone, once you're on Social Security, when you have that optionality, now we can start to fill in different brackets. Usually in the cleanup zone, you're pulling primarily from one account. Once you're out of the cleanup zone, and when you're in the ACA planning zone, and when you're out of the cleanup zone, now we can start pulling from proportionally from certain accounts. Okay, hopefully that makes sense. But again, my message here is this right here. You need to know each and every year what your brackets look like. So you need a forward-looking tax plan at the beginning of retirement. Once you're out of the cleanup zone, you need to know what your brackets look like each and every year, because I don't know how else you make these tax planning decisions. Okay, if you don't know this bracket, if you don't have this bracket laid out for your situation, How are you going to know which IRAs to pull from, which taxable accounts to pull, how much to pull from each of these accounts, how much to pull from Roth? You're kind of guessing. And unfortunately, that's what a lot of advisors do. And that's what a lot of the advice out here is. Okay, so you need to know forward-looking tax plan, and then you need to know your brackets each and every year, because that's going to change which accounts you pull from in any given year. So in summary, I know we went through a lot. Again, there's a lot of explanation that needs to happen. Let me know if this was very informative. Let me know if you guys want to see more specifics. So I kind of laid out a framework, tried to provide some specifics towards the tail end of this. But again, the tough part with specifics, as we talked about it right off the beginning, it's going to change for everybody. Everybody's situation is going to be unique. So their optimal retirement withdrawal strategy is going to differ. Again, based on how much you have on in each account, this might change significantly as well. So I can go through additional case studies if people are looking for more specifics. Let me know kind of just in broad terms what you guys thought of this presentation so far. Again, the big summary here is you need to plan. And unfortunately, I know it's easy to procrastinate. I certainly procrastinate in a lot of areas of my life. But in terms of retirement and tax planning, you cannot procrastinate. At the beginning of your retirement, or I would even say at the tail end of working, you need to know what your situation is going to look like throughout retirement. So you can have a forward-looking tax plan. You can identify what the hurdles are going to be. You can know when to take Social Security, how it coordinates with the rest of your assets. And then you can start to, once you're on Social Security, fill in the income accordingly. Okay. So thanks for watching, guys. Always remember, you don't need more money. You need a better plan. John, I'm glad you like that. Mark, I'm glad you like this presentation. If anybody's watching this on YouTube after, or if you're watching the replay link inside of our Facebook mastery group, feel free to ask any questions, any clarification questions that you have. I'd be more than happy to answer those questions. If you're watching this on YouTube, some of the presentations that I was referencing in terms of the taxable, the capital gains bump zone, Social Security tax torpedo, I'll try to link to those in the upper right-hand corner. Always remember though, guys, you don't need more money. You need a better plan. Thanks for watching. We'll see you in next week's Wealth Wednesday. I hope you guys got a lot of value out of this presentation. It seems to be a very hot button issue, and understandably so. Unfortunately, there's a lot of misinformation out there on which accounts you should withdraw from in a given year. Hopefully this helped shed some light on how we think about optimal tax efficient withdrawal strategies. Thanks for watching, guys. We'll see you in next week's video.